So UK GDP numbers have come in weaker than expected, but does it really matter? That's going to be the first thing we're talking about today. The second thing is going to be looking at the US CPI and wondering whether there's going to be an uptick in volatility. And today's trading takeout is going to be on how to use sentiment to your advantage to perfect your edge. So UK GDP growth out today, it missed slightly at 0.2% versus the expected 0.3%. But the big number was the miss in services on the month-on-month basis, which came in at negative 0.5% versus the expected negative 0.1%. Now, will this actually cause the Bank of England to, worry, perhaps? In my view, absolutely not. The reason being is that, the thing that they're most focused on is that inflation number. It's still high. It's still about 2 times over their target range. So the target range for the Bank of England is 1 to 3% to keep inflation in line with, and it's currently 7.8% yesterday. No, not 7.8%, 6.8%. Sorry. And so they're still going to press on with inflation. So we're with interest rate hikes. So we're expected the next hike to be 25 basis points. And this is probably where I'd say that you have to have a longer view on things, because the market currently is looking at what happens over the next 3 to 6 months in terms of will rate cuts be started to get priced in now? Will rate cuts come into the market? Will the Bank of England start talking about that? And there's a couple of doves, which are, people that prefer to have lower interest rates. There's a couple of doves on the Monetary Policy Committee. Tim Rayro is probably the most famous. Now, with that in mind, what they would be looking at is the employment backdrop, the wage growth numbers, because wage growth will be, unfortunately key, even though we need higher wage growth. It will be key on the Bank of England's agenda, because that is relatively high. It's 8.2% yesterday, including bonuses, I believe, or is it? It was either 8.2% or 8.5%. I'll have to double check that. 7.8% without bonuses. So high. So it's high. It's bang in line with inflation. Funny enough, though, CPI inflation. But what effect does all this have on sterling? Now, in my view, I think it does indeed soften sterling. You can look at the longer term trend line, which I will show you now. 15-year trend line here, not perfectly drawn, but if we draw it to there, even you can kind of see what formations we're looking at. All of this here looks a bit bearish. And so with, GDP data coming out around support here as well, and something that I'm going to touch on a bit more in the trading takeout, which is 65% of retail clients are long cable at the moment. Most lose money. You probably maybe want to fade the market a little bit, thinking of a fade there. That's the way that I look at markets, is looking purely at positioning, really, and what can drive through that positioning like a bulldozer. So that's my view on cable in relation to growth. I do think it's going to cause a softer cable over the next couple of weeks. And we'll still have to await the CPI numbers for the UK next week. I believe it's the 16th. I think it's the 16th, maybe the 17th. So yes, that's it for cable. So we're coming to quite an interesting point with inflation and the US. And the reason I say that is because it's likely that we're approaching the terminal rate. And so because the terminal rate has been priced at about, let's say, 5.75% for the November meeting for so long now, it's like any data that is going to really affect it will be a big surprise. And so what I'm looking out for here in relation to CPI and US equities is the extent to which we will now get a surprise. So you can see that the expected number on US core month on month is 0.2%. Year on year is 4.3%. Any kind of beat there, and with where the VIX is positioned in terms of trading it, I think it's like 13. I think we see really broad-based upticks in volatility. it is kind of seasonal for it as well. So what that means is that equities are likely to sell off if we do start getting, in line or slightly worse CPI numbers. And by worse, what I mean is, higher CPI numbers, because that will be totally averse to the Fed's aims here. What might occur is you'll see the Fed funds futures curve extend out. And that higher for longer narrative could be, really on display then, which is not good for equities where we are, especially with the employment situation worsening. I think I mentioned last week that the US non-farm payrolls on the revisions were actually 16% lower than the original report, which doesn't bode well for the US economy or the forecasters or the statistics bureaus, because it's basically shown a weaker than expected economy over a long period of time. Fewer people in work, 16% fewer people in work is quite big. Or sorry, let me rephrase that. Actually, that's wrong. 16% fewer jobs created is the better way to phrase that. But yes, we're looking at all of these for any minor beat, any softening, and I think equities rally. I think we're really in a position now where equities can start to rally if there is a softer beat, but equally if there's a worse beat, so higher inflation numbers, we do start to see the VIX pick up and equities sell off a little bit. So today's trading takeout is based on how to use sentiment effectively in your trading. And I'm going to have to change the words that were used by a gentleman that told me this a long time ago now, about 10-ish years ago, let's say. And trading is basically, okay, so you've got lots of people who don't necessarily know what they're doing in terms of, retail traders. I hope you guys do know what you're doing, but many don't. That's why the numbers are so against them. It's fair to say. And you've got to think of, okay, if the numbers are so against them and it's showing that many people are long the book one way, how can we, I'm going to say steamroller rather than the original words, how can we steamroller these people? When's the best time to steamroller these people? And because most use technicals, okay, they don't necessarily understand the volatility drivers of the market. So, for example, we spoke about sterling just earlier. Okay, will that be considered in a technical trader's repertoire? They might pay attention to it, but what are they thinking about beyond the initial event? Are they thinking, okay, people are repositioning into bonds, for example, because bonds might start going up on a softer interest rate move, these kind of things. So what does that then mean for the currency? If bond yields are going down, does that mean that the currency weakens? And that's kind of my thinking there. I don't think they pay attention to this stuff. So there might be a nice support drawn, and they might be buying that, getting long, thinking, oh yeah, it's going up. Fear of missing out jumps in, but then the actual macro stuff takes them out. And when you can identify that uninformed traders are very, very long one side and the book is weighted too heavily one side, it means that there's lots of stops that you can take out on the downside or upside, whichever way you're going. And that tends to be how I like to think of things in the market. Not for too long. This is more sort of maybe intraday, maybe, a bit of a swing type thing, but it tends to be very momentum driven, especially in the FX stuff. And it tends to be quite a nice way to realize when your signal is right and realize when your signal is wrong, because it does move quite quickly if you tend to be right on the idea.